Good morning, everyone. Thank you for being here. My name is Drew McMillan. I'm one of the partners at Southwestern Investment Group, and we've got the privilege of hearing from and talking to Larry Adams this morning. So Larry is the Chief Investment Officer for all of Raymond James. And for those of you who are clients of Southwestern Investment Group, you're familiar with the Raymond James name. So Raymond James is one of the largest independent investment custodians and investment firms in the nation. They custody over $1.2 trillion of assets. And as an independent firm, we have chosen them to hold our clients' investments, which means we use their platform and to manage the investments. And they provide us a lot of resources to better serve you. And so one of those resources is having access to great minds like Larry that can give us some good feedback and insight to what's going on in the world and how it how it impacts the investment markets. And so we're grateful for his time this morning. Larry has spent a career in the investment world. As I said, he's the Chief Investment Officer for Raymond James. Prior to joining Raymond James in 2018, he held the role of Chief Investment Officer of Americas and Global Chief Investment Strategist with Deutsche Bank. So he comes with a wealth of experience. He's obviously very busy right now. And so we're grateful for his time here. He's been featured on CNBC and Bloomberg, as well as publications, Wall Street Journal and Barron's magazine. So Larry, thank you for taking time and being with us today. I know you've got a lot going on.
Thank you for having me.
Good. I'm looking forward to this. This discussion will be a Q&A here, and we've asked to have questions submitted ahead of time. And if we don't cover what you're looking to have answered, please reach out to your advisor after the call, and we'll have some discussion and get some feedback for you here. But Larry, these are interesting times, and so thanks for taking the time here. We have been reminding clients, though, that these are scary times, but they're also not abnormal, meaning that in the longevity of healthy economic cycles, we fully expect, and it's hard to predict when they're going to happen, but hard times like this, these are pretty normal. Is that right?
No, absolutely. And as you said, if you just take a step back and you look from a very macro perspective, I always like to start off with like 5 different points. And the very first one is a story about the difference between an optimist and a pessimist. And it's through these 2 farmers. And every time it rains, the optimist says, "This is fantastic. My crops are going to get all the water that they need. They're going to grow to the sky." But the pessimist says, "Oh, this is terrible. All the seeds are going to get washed away." And then the sun comes out and the optimist says, "Wow, it's photosynthesis. My crops are going to get all the nourishment that they need. This is going to be a record harvest." But the pessimist says, "Oh, this is terrible. It's going to be scorched earth." So one day the optimist invites the pessimist to go fishing, and the optimist catches a fish and is dangling off the boat by about 10 yards. So he calls to his dog to go get the fish, and the dog leaps out of the boat, walks on water, grabs the fish, wags its tail, walks on water, jumps back into the boat and gives the optimist the fish. And the optimist says to the pessimist, "What'd you think about that?" And the pessimist says, "Man, your dog can't even swim." But I think that is a very good setup for the market, in the sense that there are people that are overly optimistic and there are people that are overly pessimistic. And it's my job, your job, really to be the realist out there, to really get behind the facts, the figures of what's actually taking place, to help provide guidance in how to manage portfolios. And I think that leads to my second point, that this is the time where this is particularly critical, because if you look at the news, if you look at what's happening in the market, both of them love to have narratives. And the problem with that is that those narratives tend to like to extrapolate the current environment for the foreseeable future. And if you look back through time, there have been plenty of examples of that, right? If you look back in the late 1990s, early 2000s, the tech revolution was never going to end. The housing bubble in 2007, 2008, it was going to continue. Obviously, it didn't. More recently, everybody thought that the stay-at-home companies that benefited, right? Your streaming companies, your service companies, that those were going to continue to grow forever. But it wasn't going to happen. And then today, I think the narrative is the fact that inflation is never going to come back down again, right? And everybody's concerned about that. But I think as we go through these discussions, I don't think that that's a permanent situation. I think you're going to see that improve as we go into the remainder of this year. The third point I wanted to bring up is the fact that, as you said, performance has been extremely challenging this year. When you look at the S&P 500, it's off to its worst start year to date in more than 50 years. The problem with that is that there really hasn't been any place to hide because the bond market is off to its worst start in history. So I think it's important to understand that diversification, while it hasn't worked as much this year, there are time periods, like you said, where things can kind of go awry. But for the most part, diversification is still a standing principle and needs to be valued by investors. And the reason for that is really the fourth point, that we've had unprecedented time period right now. A lot of people talk about black swans. Unfortunately, we've had a flock of them, right? I mean, if you think about it, we've had the first pandemic in 100 years. You've seen Europe invaded for the first time in 60 years. Inflation, the highest in 40 years. And that's caused the Fed to, believe it or not, when they raised interest rates by 3/4 of a point last week, that's the first time they've had to raise it by that magnitude in almost 30 years. So you're seeing unprecedented events taking place. And I think the market just needs to digest a lot of those things that need to take effect. And by the way, I think a lot of these events have already been priced into the market, as you said. And then the final point I would just make is that the best medicine for a lot of this volatility is working with your advisor, sticking with your asset allocation, because again, we put so much work and effort in figuring out what's the best portfolio that you should probably revert back to that. And I think what's really important is the fact that you can't have what they call these, ill-timed, emotionally driven decisions where you change your portfolio, because time and time again, we've found that is what really leads to the most significant underperformance by investors. And, if you read all the financial textbooks out there, right, they would tell you that there's two emotions that dictate all financial decisions, and that's fear and greed. I would tell you that that's been one-upped, and that's panic and euphoria now, right? And I think we got to combat not doing that, because if you just think about this, if you go back over the last 20 years, the S&P 500 has been up ballpark about 7% on average. If you just missed 20 of the best days, think about that, 20 days of a total of more than 5,000 trading days. So it's a very, very minuscule number of days that you would miss. If you miss those 20 best days, your performance would go from being up on average 7% to being flat. And the reason we bring that up is because when do you think those best days occur? They occur when the market goes down very quickly. And if you think about it, just human nature, you get out when the market goes down and you miss those big rebound days. So again, sticking to that asset allocation, having a plan, working with your advisor, I think that those are all critical dynamics that you have to keep in perspective.
Thanks, Larry. And I'll remind our clients that when we're doing financial modeling and forecasting, we're using conservative rates of return based on 40, 60-year historical data, which means we're trying our best to bake in the fact that these inevitable periods of market declines are going to happen. And so your financial plan is based on that fact. And so this is not surprising to us that we're experiencing a year of potential downturns in the market. So just zooming in a little bit here, Larry. So the big question that is on everyone's mind are we heading towards a recession? Is it, I'm sure these things are hard to predict, but how likely is it we're moving that way? And if so, based on some different outcomes, how has that historically impacted the market?
Yeah, so I would say for this year, I don't really see a recession unfolding. I just think there's too much momentum, too much good things if you look at what's been happening, right? I mean, if you look at the number of jobs that are being created, it's a significant amount of jobs. We're roughly around 400,000 jobs per month. And one of the little things that we like to look at is withholding taxes. That's probably one of my best indicators of how the job market is doing. And the reason I would say that is that if you own a business in the United States, every single week you have to collect all the taxes of your employees, and you got to write a check to the government. And the good news is that the government tells us how much they are collecting. And if you looked at those numbers, what you would still see even today is that those numbers are at an all-time record high, and they're increasing at a rate of about 20% over where they were last year. What does that tell me? that tells me, A, that we have a very solid job market where we're not only just creating jobs, but people are getting more. But the more important part of that story is that the consumer, which is the biggest part of the US economy by far, about 70% of the US economy, has more money to spend. So that's why I think we still have a lot of momentum from the consumer spending. Second, if that wasn't enough money, just keep in mind that because of all of the stimulus, because we didn't spend as much during the pandemic, there is still $2 trillion in excess savings sitting in bank accounts that people could withdraw from to continue to spend on the different things that they need to spend on. So that's still a lot of money out there. And then the third thing, and why I don't think a recession is going to happen near term, is that if you just look at what people are doing, right? If you look at mobility indicators, if you've been to an airport, right? We've been calling this the summer revenge travel because, people have been pent up for the last 2 years. Everybody seems to be getting out. Airports are jam packed. If you look at trains, if you look at trying to get a hotel or a vacation rental this particular summer, they're all really packed. So people are still spending, going to restaurants, going to the movie theater. Those things are all picking up. So I think that that's still a lot of momentum, at least near term, that should help this economy. Now, once we get into next year, I will tell you that our economist has made a call that he thinks that there is a 60% chance of a recession occurring next year in the second and third quarter. But I think you need to look behind the details. While that is his call, keep in mind that he is talking about an extremely mild recession. His GDP forecast, so the growth of the US economy, he believes is going to fall 0.1% in the second quarter, 0.2%. So I would call that touching a recession, not swimming in a recession, a very, very mild recession unfolding next year.
Okay. And so historically under those options there, and then obviously you've got an option, which is it's far worse than anybody thought, but it looks like unless we get some major changes in some data that we're seeing, that's probably unlikely. If we have these periods of very minor or touching a recession, as you put it, how has the market kind of performed following those periods?
Yeah, so we break it down into 3 different scenarios. Okay, soft landing, which by the way, I don't think is off the table. I still think that there's a reasonable chance, right? We have it at still 40% chance. If that occurs, you make up this lost activity that we've seen in the equity markets, and you move higher on average double digits over the next 3-year period. So that's the best case scenario.
Okay.
If we have this mild recession, on average, the equity markets decline about 24%. So think about it. We've been down 25%. So we've already priced in, at a minimum, a mild recession. And then if we get a more severe recession, which I think is a very low probability, right? When you talk about severe recessions, you're talking about the housing crisis, the great financial crisis in 2007, 2008. You're talking about when we had extreme valuations with the tech bubble that led and 9/11 that caused that recession. I don't see that unfolding. I don't see the big imbalances out there in asset prices, valuations really being distorted to the upside. So I don't think that that's going to happen. But if that happens, you're talking about the market being down on average around 37%. So I think the market's already priced in this mild recession. And I still think that there's a reasonable chance we can get to that more of a soft landing going forward.
Well, great. And I would take a moment here to remind everybody that the market does move kind of ahead of the news. And if you were to go back and look at headlines from March 23rd, 2020, which was the bottom of the market during the pandemic and COVID crash, there were no good news that was going on. The pandemic levels were still increasing. The rate of unemployment was still going up. And yet the market started kind of pricing in that there was going to be a recovery coming out of this. And so we hear it often that we ought to wait until we start to see some good news happen in the market or in the economy before we really start thinking about investing or getting back into the market. But oftentimes that can be too late.
Drew, to expand upon that, we released an analysis last week that if you went back to 1950, there have been 10 different time periods where the equity market has had what they call a bear market, where it's fallen 20%. And admittedly, it is very challenging for anybody in my shoes or your shoes to figure out what the ultimate bottom is. But in those 10 different occasions, if you would have gotten into the equity market the day that the market went down 20%, if you look out 1 year later, you've been up 70% of the time, and you've been up on average about 15%. If you extend your holding period and you look out 3 years from that day that the market was down 20%, you've been up 90% of the time, and you've been up on average about 10% every year after that occurs. So to your point, the equity market is a forward-looking indicator. If you feel the recession, it's already priced into a recession. When you feel the bad, it's already priced in. It's looking out if you think about it.
Yeah, well, it's a great data point, because especially an equity investor typically has more than a 1 year time horizon. So assuming 3 years or more, if we've got a 90% chance that we're going to be up quite a bit over the next 3 years, that's a good indicator. It seems that all eyes are on the Fed. The Fed is all the headlines, and what are they going to do? I know they've got a meeting here and not too long to talk about some next what's going on in the course of action, if there's going to be further rates and rate increases, talking about 75 basis point increases again. And so would you mind talking about Raymond James' kind of outlook on, and this goes hand in hand, I know, with inflation and rates, and how that's going to impact investors?
Yeah, so that's really why our economist thinks that we could have a mild recession next year. We were and remain in the camp that the Fed shouldn't raise rates as much as they right now are expected to raise. Now, will they raise at the next meeting? I think they will. It's either going to be 50 or 75 basis points. Right now, our economist believes it's going to be 75 basis points. But I will tell you that if you look back, and by the way, I'm a professor of finance at Loyola University here. And if you look at the textbooks, there's always a lag when it comes to the impact of interest rates. And even with a lag, you're already starting to feel the fact that interest rates are rising, right? I mean, look at the housing market. You're starting to see some softening there. You're starting to see mortgage applications are down more than 30% from where they were at the beginning of the year. Think about this. If you want to talk about human behavior, about a quarter or more of new mortgages are adjustable rate mortgages. Why? Because if you think about it, that rate's a little bit lower, and people are being forced into doing that so they can afford a bigger house. That could be a negative, but the reason they're getting that is because they need to afford that house. The reason that 25% plus is significant, 18 months ago, 4% of people were using adjustable rate mortgages. So you're starting to see that impact. If you look at small businesses, obviously their interest rates are going higher. They're north of 6% now when it comes to getting loans. Why is that important? Well, about half of the people that get jobs in the United States are with small employers. So I think we need to be very careful from an economic perspective and a growth perspective. Just as important, I think you don't want to overreact, as I mentioned earlier, to inflation. When I look at all the forward-looking indicators, you are seeing the early signs of these inflationary pressures starting to come down. You know, some of the harbingers of things that told us that inflation was coming were transportation costs, right? The price to move goods across the Atlantic or the Pacific, to move, trucking is a big part of, from the port to actually how you get into the store. Well, those rates are falling pretty significantly. In fact, if you look at trucking year over year, so this time last year, the price for a trucker is actually lower, and would actually be lower if you adjusted it for the fuel surcharges that they're putting out there. So when you look at that is coming down. You want to talk about inventory levels? People were worried there weren't going to be things that we could buy in stores. You've seen the biggest retailers in the world right now have 20 to 30% more inventory than they did prior to the pandemic. And I think that's significant. And I think when we go through July, you're going to see that now famous Prime Day, right? When Amazon has all their big deals. I can tell you right now, that those big retailers are bolting onto that. So you're going to see the Targets of the world, the Walmarts of the world, other retailers coming out. I think you're going to see some significant liquidation of inventories during the month of July. That's going to bring prices down. When you look at commodity prices, they're starting to come down, particularly one of the ones that's the most economically sensitive, like copper, that is coming down. Discounting at stores. I mean, if you go to the mall, right, you're starting to see it. And I think one of the ones that the Fed is watching very closely, and this is kind of an interesting dynamic, is wage pressures. And you have to think about during the most recent couple of quarters, where have been most of the jobs being created? It's been in the technology space. It's been in the warehousing space, right? Those tend to have a little bit higher average salary or hourly wage set to them. Well, if you've looked over the news, you know, the Amazons of the world, the Walmarts of the world, the Target, they say that they're fully staffed or even overstaffed. So and even some of the technology companies, they're starting to lay off some people. The point is that those higher wage jobs are not going to be hired, or potentially, you know, there could be some layoffs. Where is the job creation right now when you look at that report? It's in the leisure and hospitality section of our economy. Those tend to have lower wages. So when the numbers come out and you see where the wages are going, just by definition of where the jobs are created, you're going to see some of those wage pressures start to come down. And I think that could make the Fed a little bit more comfortable. So I think the bigger Fed meeting from my vantage point is when we get into September, right? Because there isn't one in August. There's one in September. Hopefully the Fed will be able to see a few months of maybe inflationary pressures, hopefully starting to roll over, where they won't have to be as aggressive.
So that's kind of the ideal scenario we're looking for, is to start to see some drop in inflation and the inflation rate. So the rates, Fed rates, are not going to go up as much, which would not have as much of an impact on unemployment. Again, we're talking here today with unemployment being very, very low and being a very good, healthy spot. So there's probably some room to run there, but we don't want it to get out of control, essentially.
Correct. And I'm in the camp, and you know, there are some Fed members in the same camp. I think having a little inflation with job creation and putting people back to work is much easier to deal with than having a hard landing where all of a sudden people don't have jobs, right? And I think that that's probably, you know, we can talk about some of the risks out there. You know, I think one of the biggest risks right now for this recession is what we call this self-fulfilling prophecy, right? Where consumers all of a sudden get very nervous and then they don't start to buy, right? And by the way, a CEO of a company is a consumer. So if consumers start to pull back and businesses start to pull back all simultaneously, we can walk ourselves into a recession, right? If everybody pulls back at the same time. So that's something that I think we got to keep a close eye on, because confidence is that one indicator that all economists have a hard time getting their hands around, right? You know, most models are kind of linear, but the way you and I think is what can take things up and make it better than what people expect. If we all feel great at the same time, we spend more. But conversely, if we all turn negative at the same time and pull back, that can lead to a much more pronounced downturn.
Yeah. Well, we've heard it said a couple of times. I feel like I'm living in the late 70s, early 80s all over again. What are some key differences that would make this one very different than that period we went through?
Well, I think there's a lot of differences. First of all, I think if you look at the way the economy is, right, it's a lot more service oriented than it was back then. It's a little less manufacturing centric, right? So I think services is a very important part of that. Clearly, interest rates are significantly lower than they were back then, which is a positive. I think corporations in general have become much better and more efficient at managing their businesses. And I think this whole technological revolution that's taken place will continue to help bolster those businesses. I think one thing that's really important to understand too, from an investor's perspective, is that the equity market isn't necessarily the economy, right? And if you think about it, during the pandemic, when everything went down, well, what was really driving it was a lot of those tech companies, because tech represents roughly 25 to 30% of the S&P 500. It's not, of the total economy, it's not that big, right? So I think it's always important to differentiate the equity market versus the economy when you're positioning your portfolios.
Yeah, and the idea of stagflation has been written about some, but a key component of stagflation is high unemployment, and we're pretty far from there. I mean, that's fair to say, correct?
No, I agree with that. And, employment conditions remain healthy here. I think if I was more concerned about stagflation, it's one of the reasons why we continue like the US equity market. I'd be more concerned about that over in Europe, right? I mean, the US economy is much more dynamic, if you will. The Fed is much more forward looking. We have a lot more flexibility from a corporate level when it comes to layoffs and hiring, those types of things. It's much more challenging over in Europe. So I'd be more cautious over there. And also keep in mind that Europe has a much closer integration with what's happening over in Ukraine and Russia, which makes it, more likely that they could have a stagflation, if not a recession, sooner than what you're going to see here in the United States.
Well, and let's talk on the equity side. Equity investors, the reason that we own equities is for earnings. And so we're, a few days away from wrapping up Q2. How have earnings looked so far this year? And then what are we kind of keeping an eye on for second quarter?
Yeah, I mean, I think earnings so far have been better than what people have expected. I think one thing that's very important from my vantage point is that I haven't really seen earnings being revised lower. And by the way, that is a huge call. I tell people that earnings estimates for the S&P 500 are kind of like my New Year's resolution, right? Every year I come into the new year and say, I'm going to lose weight, I'm going to exercise every day, and I'm going to be much better, right? And as we go through the year, well, I'm not going to lose as much weight, right? I start to downgrade my expectations. If you look back over the last 20 years, on average, equity forecasts for the earnings for the S&P 500 get revised down systematically from the beginning of the year to the end of the year, and it's typically 4 to 5%. So far, year to date, that has not happened. It's actually been revised up roughly somewhere between 2 to 3%. So I still think that the earnings story is pretty powerful. And one of the things that, when you hear people talking about earnings are going to be revised significantly lower, et cetera, because GDP is coming down. The one thing I would caution people about is that earnings are driven off of what we call nominal GDP, right? That's the actual dollar amount that you and I spend, the dollar amount, right? GDP that gets put out is adjusted for inflation, okay? So there is a big difference. And if you look, for example, that's the reason why a lot of economists are bringing their GDP forecast is because inflation is picking up. So it's taking it off from that nominal down to that inflation adjusted GDP. Earnings are reported on that dollar, that top line number. And again, I think companies have been able to get across a lot of these price increases, and I don't think they're going to be as bad as what people think. And we're still looking for this year of earnings being in the mid-single digits. And I think the power of that number is the fact that as earnings continue to move higher and the equity market continues to go lower, that has driven the valuations down to levels that are actually cheaper than they were prior to the pandemic even. So I think valuations are actually very attractive for the equity market at current levels.
Yeah, going back to your initial comments about the optimist versus the pessimist versus the realist, we're talking just real numbers here and real data. It creates an interesting argument for buying opportunity because of that. We have earnings estimates that are being revised, maybe even upwards, and then we're looking at stock valuations that are down 20 to 30%, depending on what company that you're looking at, and it could create a buying opportunity. Going back to that, average equity investor being north of 3-year time horizon, it seems like it could be a good time to be an owner of some of these companies.
Yeah, I think I agree with you that if you have a long-term investment horizon, which you should if you're in the equity market, I think now is a good time to look this as an opportunistic time to, if you were underweight your equity exposure that you intend to have, to start to, fund it back to those levels that you want to have. I think that overall the earnings market is going to remain solid. I think that there are certain areas that you should particularly look at. The cyclical areas that should do well as the economy does okay. I think tech continues to be an area, by the way, that continues to outshine, if you will. When people look at earnings, right, it's kind of an interesting dynamic if you think about this. You look at the PE valuation of the S&P 500, and it's forward looking, but it's as of the valuations of earnings today. But what do we hear when we go through earnings season? It's better than expected, right? And by the way, better than expected, a lot of times it's like saying the sun's going to rise tomorrow. Most of the time, earnings come in better than expected because CEOs know how to, quote, play the game, right? They kind of downplay their earnings expectations to come in and beat. So my point is that even the valuations that you're seeing today are probably less expensive than reality because this earnings number is likely to come in better than expected. And, an area that tends to, in my opinion, that tends to come in, if you look back, the technology area continues to come in and beat their earnings expectations quite a bit. So that's an area that I would look at. I think energy, I don't know if you want to get in specific areas, but I think energy, right? If you look at the price of energy, those energy companies have not rallied as much as where the price of oil has gone, right? So I think that that's an area that can continue to do well. As well as interest rates have gone higher, I think financial companies should continue to do well. They'll be able to increase their loan rates, right? So they should be able to increase their earnings. So there's definitely some opportunities out there for long-term investors, I believe.
Well, a lot of positivity here, which is good. Let's wrap up our discussion maybe by just hitting on the bond market real quick.
Yeah.
So obviously it's a pretty rare year to have, as you mentioned earlier, both equities and bonds down in the same year. That doesn't happen very often. Now, obviously, the good news when rates go up is that new bonds and our savings accounts, et cetera, if you're a saver, we're going to be able to get more interest. The bad news is if you're looking to borrow money, it's going to be more expensive for you. But there's obviously a reset that happens with bond prices. And so we remind our clients that, the resale value of your bonds, if you were to sell them, has certainly dropped in value. But if we hold them to maturity, we're going to get all of our money back, or your managers will if you're investing through a mutual fund or an index fund. And then they turn around and reinvest that in higher yielding bonds. So there's going to be kind of a natural reset, and that happens in the bond market. Is that fair?
I think that's absolutely correct what you said. When you look at where rates are, our fixed income strategists think that we were probably pretty close to a peak. Maybe we go up, we test once again that roughly around that 3.4 to 3.5% level. But by the end of the year, they think that we're closer to that 3% level. And by this time next year, because of some softness in the economy, rates could come down even further. So there's an opportunity that, to your point, that the bonds can do well in that environment. Regardless of that, the fact that bond yields for so long, people have been looking to get into higher yielding bonds. And when you talk about high quality investment grade, so the highest quality companies out there with yields around 5%, that seems like it haven't been an opportunity. So to your point, some of those bonds that are maturing, you get to reinvest now at a higher yielding investment. So that's a positive. And corporate bonds, in our opinion, assuming that the recession at worst is mild, they should still do fairly well in that environment.
Well, great. Well, let's wrap up here. Thank you, Larry. I know you're busy and you got a lot going on. We appreciate you spending the time with us. We covered a lot today, and there was a lot of great news, a lot of good news there, and just a lot of good tenets of investing. If you have additional questions, don't hesitate to reach out to your Southwestern advisor. We'd love to spend time with you, updating your plan, talking you through it, seeing if any changes ought to be made to your investment. So everybody, stay safe and stay healthy. And hey, Larry, thanks again. Appreciate your time.
Thank you, Drew.
Take care.